How's everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about an M&A transaction that had some unusual conditions. I'm going to bring in an article here. So this is from S&P Capital Intelligence, and this article is called Provident-Lakeland Unusual Deal Approval Conditions Tell Cautionary Tale. So the FDIC approval of the Provident Financial Services Inc. Acquisition of Lakeland Bancorp was handed down with unusual conditions that could become the norm. So after pending for more than 555 days, it's a pretty long time, the FDIC gave the companies a green light, but with conditions that the combined entity must stay below specific commercial real estate or CRE concentration ratios, make more mortgages, and retain more capital. Provident, which also must raise $200 million prior to closing the deal, is confident in its ability to execute on the mandates. The Jersey City, New Jersey-based bank believes that the conditions were handed down a result of the current operating environment. Definitely so. The conditions reflect the environment today, and they're consistent with other recent approvals that we've seen. Provident General Counsel and Corporate Secretary Bennett McDougall told S&P Global Market Intelligence in an interview. Deal advisors and lawyers say the slew of conditions are unusual, but could become more common as regulators increasingly scrutinize merger. The combined institution is really going to be expected to address those issues quickly as part of the approval. The set of conditions reminds applicants to get their financials and pro forma numbers tightly locked in and supported prior to applying. The companies, which are still awaiting Federal Reserve approval, expect the transaction to close by June 30th. So, and then it gives some financial highlights of, Provident Financial Services and Lakeland Bancorp, some of the capital and the lending. And then, so now let's get into here. So there are three areas where the conditions were put in. So we've got commercial real estate, we've got capital, and we've got mortgages. So, in commercial real estate, under one of the FDIC's provisions, Provident is required to maintain its ratio of commercial real estate loans to total capital and reserves at or below the levels set forth in the three-year projections supporting its regulatory application. The FDIC established targets based on the pro forma projections that we provided that were part of the application. The CFO did not disclose what those specific projections were when asked in the interview. So the inclusion of this provision is likely related to the ongoing operating environment in which CRE is facing a lot of stress and banks with exposure are under a microscope, especially with what's going on with New York Community Bancorp right now. The company's combined footprint around New York City and New Jersey may have also led to the provision. If they're concerned about CRA loans in New Jersey, New York, wherever they're lending, yes, I think they want to try and tighten that up and make that a provision. So now let's look at heightened capital. So the combined company CRE exposure could be blamed for the heightened capital requirements imposed by the FDIC in the deal approval. Right now, regulators are focused on CRE to total capital ratios and reserves. They may say that their CRE levels are such that they require additional capital to support the risk. For 3 years after the deal closes, Provident will have to maintain at least 8.5% Tier 1 capital to total assets above the 4% regulatory minimum and at least 11.25% of total capital to risk-based assets above the regulatory minimum of 8%. Providence must also raise $200 million in capital before the deal completion. The company plans to use the funds to pay down the combined entity's borrowings to boost capital ratios. Capital-related provisions will likely become more common in deal approvals as the FDIC is acting with caution for the banking system's safety and soundness. This kind of condition will be more likely to crop up in deals involving banks engaging in specific areas of lending because you have to hold more capital against them. The need to raise capital comes at an inopportune time, given where interest rates are. If you need it, That's the worst time to have to try and get it. McDonald said in an interview, if a deal is under the gun, the market will take advantage of you to a certain extent in terms of rates. It is not going to be able to be raised on the most favorable of terms. So, and then finally, more mortgages. In another unusual condition, Provident will have to develop an FDIC-approved action plan to improve home mortgage applications from and originations to all demographic populations within the combined bank's reasonably expected market area. Regulators used this provision more recently in the merger of equals between CBTX and Allegiance Bank shares, which changed to the name Stellar Bancorp. Though that provision was more targeted as the institutions had to make more mortgages to African Americans specifically. Advisors said the requirement is likely a result of Lakeland's recent redlining investigation. Most of these provisions are really to address where the applicant was stronger than the target and or the target had pointed issues, like an enforcement matter. Because the target has certain challenges, they put these provisions in there so that the acquirer adjusts those challenges specifically. So, 3 unusual conditions, obviously commercial real estate, heightened capital, and then more mortgages. So couple of thoughts here. Like, yes, I do think, regulators are being prudent here. Perhaps taking a look at some of these things. Obviously, New York Community Bank is a big issue right now. That's it could be a canary in the coal mine, as it were, in terms of the commercial real estate market and the effects that could have on many banks in that New York, New Jersey area. But also, I mean, these kind of conditions could become a little bit more the norm. Now, I mean, I do worry that these banks could be asking for trouble here because they're kind of putting they're basically handcuffing themselves by accepting these very heightened capital ratios. I mean, they have to go out and raise $200 million. They're going to have to do that at a point in time where they're going to have to pay a lot more money to get that capital, but then they're going to use it to basically pay down their borrowings, against probably, Federal Home Loan Bank line of credit. So they're going to pay down those borrowings, which might help them in the short run. But then if they have to go out and re-borrow that money down the road, and they have to keep these very high capital levels, that could prove very, troublesome. Mortgages, how good is the mortgage market? I mean, maybe they can't quite make enough loans, or maybe they don't want to make X number of mortgage loans because maybe maybe the residential mortgage market goes into the toilet. I mean, who knows? I mean, so there's just a lot of things here. I mean, this could work out fine at the end of the day. It could also really hamstring them. It could really handcuff them and really put them in a difficult spot if the economy begins to sour. So very interesting thing here. Like I said, I just wanted to point this out again. It's kind of like this evolving door, if you will, of around the M&A landscape right now. Like I just did another episode on the changes that the FDIC and the OCC want to make to the merger and acquisition process. So I would definitely encourage people to go check that out if you have a vested, or if you just not invested, but if you just have an interest in the M&A type market or what's going on there with bank M&A. So but these conditions are very important because they, like I said, I mean, they could become the norm on a lot of transactions. And the question is, if these become the norm, does this sour potential M&A deals going forward? I mean, they're looking at all the changes right now with the FDIC and the OCC, and now these new unusual conditions that are being put into the deals. Like, what does this ultimately do to the M&A landscape? So, like I said, just wanted to share that and point that out with everyone. I hope you will check out some of the other episodes that I posted up this weekend, and definitely make sure to check out the weekly banking update, because that is kind of the main flagship show of the channel. And and if you like this one, please make sure to like, share, and subscribe. That always helps the channel. Make sure to check us out on YouTube, Rumble, and all major podcast platforms. And I will be back to see everybody again real soon. Thanks a lot.